Short selling is a trading strategy used in financial markets where an investor sells borrowed assets, typically stocks, with the intention of buying them back at a lower price in the future. This strategy allows investors to profit from a decline in the price of the asset being sold short. Now, let's dive into a detailed explanation of short selling. Let's discuss the mechanics of short selling. In a short sale, the investor borrows shares of a stock from a broker or another investor and sells them on the open market. The investor is effectively betting that the price of the stock will decrease over time. If the price does indeed decline, the investor can repurchase the shares at the lower price and return them to the lender, pocketing the difference as profit. However, if the price of the stock increases instead, the investor will incur losses when repurchasing the shares at the higher price to cover their short position. Before initiating a short sale, the investor must borrow the shares from a broker or a custodian firm. This borrowing process involves agreeing to pay interest on the borrowed shares and posting collateral to cover potential losses. The availability of shares for short selling depends on factors such as stock lending programs, market demand, and regulatory constraints. Not all stocks may be available for short selling, especially those with limited liquidity or high volatility. Margin requirements. Short selling typically requires the investor to hold a margin account with their broker. Margin accounts allow investors to borrow funds or securities to leverage their trading positions. Brokers may impose margin requirements, which specify the amount of equity or collateral that must be maintained in the margin account to support the short position. If the value of the shorted stock rises too much, the investor may receive a margin call, requiring additional funds to cover potential losses or to increase the margin. Risks of short selling. Short selling carries significant risks as the potential losses are theoretically unlimited. If the price of the shorted stock increases substantially, the investor may face substantial losses when repurchasing the shares to cover their short position. Short squeezes can occur when there is a sudden, sharp increase in the price of a heavily shorted stock. This can force short sellers to buy back shares at increasingly higher prices to exit their positions, exacerbating the upward price movement. Additionally, short sellers may face the risk of dividend payments. Since short sellers must eventually return the borrowed shares, they are responsible for paying any dividends issued by the company during the shorting period. Regulatory considerations. Short selling is subject to regulatory oversight and may be restricted or prohibited in certain markets or under specific circumstances to prevent market manipulation, excessive speculation, or systemic risks. Regulators may implement measures such as short sale bans, uptick rules, or circuit breakers to maintain orderly markets and protect investors from potential abuses. Uses of short selling. Short selling serves various purposes for investors and traders, including speculation, hedging, arbitrage, and market-making activities. Speculators may short sell stocks they believe are overvalued or facing fundamental challenges, aiming to profit from a subsequent price decline. Hedgers may use short selling to mitigate downside risk in their investment portfolios, offsetting losses from long positions in other assets. Arbitrageurs may exploit price discrepancies between related assets or markets by simultaneously buying and short selling securities to capture profits from market inefficiencies. Overall, short selling plays a crucial role in financial markets by providing liquidity, price discovery, and risk management mechanisms.